Hello, and thanks for joining us to review a first lien HELOC in comparison to a traditional 30-year fixed mortgage. Over here on the screen, we do have the first mortgage, the traditional mortgage, 7.375 that was taken out about 2 years ago. Rough balance of the current mortgage, about 164,000. So we're going to look at what the balance timelines are in comparison of the two. And over here on the right side, we have the first lien HELOC, 164,000 with the variable interest rate currently roughly around 8%. In this scenario, we had about $7,600 coming in as income that's going to be deposited into the checking account. When it does, it's going to automatically sweep over, drop the balance from the 164 down to about the 157. We then looked at expenses going out, which were about 4,700 per month. And with that combination, we're going to see what the results are. Down here, we put the annual property tax, annual HOA, and insurance all together here to kind of get that as part of the equation too. So on the current mortgage, 28 years left to go, equates to about 224,000 of interest left on top of the 164, meaning 136% of the loan is still interest left to be paid, which is more than what the existing balance is. So when we come over to the first lien HELOC, again with 7,600 coming in, we can even round this up to 5,000. Let's take a look, see how that does. We pay off in 8.5 years with 62,000 of interest on the 164,000. So now we drastically reduce the percentage of the loan that is the amount of interest. Again, based upon the dollars that are flowing in versus the dollars that are flowing out, we can make that achievement. When we look at this as a comparison to a 30-year fixed loan, if you were to take out 164,000 and pay 62,000 of interest, that lender would have to provide a 2.25% in order to have that amount of interest. So even though we're using a variable interest rate that's about 8% right now, we see that we're greatly outperforming the traditional mortgage on the left side here. We also looked at if we added a car loan, about 25,000 balance that has about a $500 payment, 550. If we added that balance on, now we can take out the expenses of the $500. We can see our timeline goes down, and then, excuse me, the amount of time it takes to pay off the car loan is going to be roughly a year. So that would be how we could incorporate the debt as well, create some additional cash flow, pay off the auto loan quicker, and then still have access to the line of credit up to 85% of the appraised value. So the key ingredients to this formula, again, are going to be the loan amount, the income, and the expenses. So we'll be able to use this spreadsheet to really track and determine the outcome of those scenarios. So again, that's the first lien HELOC in comparison. Feel free to call or email or book an appointment with additional questions, and we'll be glad to review the first lien HELOC. Thanks.